Hello, everyone. My guest today is George Elfond. He's the CEO of Rallyware, a performance enablement platform and a renowned global expert in implementing future of work technologies. He was instrumental in helping companies around the world to drive their workforce performance and bring the best in each individual through data-driven training and engagement embedded in daily workflows. George, you ready to take us to the top?
Excellent. Thank you. Really nice to meet you.
You bet. Okay, tell us about Rallyware. What does the company do, and are you pure play SaaS?
Excellent. Yes, we are a pure play enterprise SaaS platform, as you mentioned, performance enablement platform. What does it mean? We see three trends in the future of work. First of all, work is getting very distributed, but the current tools are designed for mainly hierarchical organizations, and that's a problem. Second is data is very important in driving the workforce productivity, and it's not being utilized as much in the HR tech and especially in the learning solutions. And the third is the millennials. Millennials are increasingly in the workforce right now, and then they demand tools that are effective for their personal and professional growth. And based on that, what Rallyware is, we're basically connecting the learning activities with operational and performance data on each of the members of the workforce.
OKRs, KPIs, things like that.
Exactly. And based on those, we'll provide specific activities for each person in the workforce.
So when you say enterprise, give me a general sense. The average company is going to pay you what per year to use your technology?
So there's no such thing exactly as the average for us, but I'll give you a range. We start, and it's a pretty wide range, but we start at around 50,000 in ACV, and the contracts could go all the way up to about $1.5 million.
I understand it's difficult to give an average because you really do have different cohorts. It's just the tricky thing with the show is we don't have time to talk about every cohort. So, I mean, if you took total revenue divided by total customers, it's fair to say an average is going to be closer to the $50,000 ACV or like $1 million ACV.
It's somewhere in between, but it's probably, I would say it's in a couple of hundreds.
Couple hundred. Okay, good. So not 50, but a couple hundreds. And so let's role play for a second. If I'm signing up right now to use you guys for, let's say, $300,000 ACV, how big is my team probably?
So your team for a $300,000 your team would probably be around 10 to 15,000 people.
Okay, so that is your sweet spot. I mean, when you look at your leads, your sales motion, all that, you're targeting companies at that range, north of 10,000 employees.
We're targeting more than 10,000. You get value if you're about 1,000 or more. If you're less, you still get value, but in many cases, you could do a lot of it with the manual process.
What's your team look like today? How many people?
So we're around 60 people right now.
And what's the split between engineers and everyone else, or quota-carrying sales reps?
So we are pretty heavily on engineering. We're about 2/3 are engineering right now.
Okay, so call it 40 people engineering, and then how many folks are quota-carrying?
Quota-carrying, we have 4 enterprise sales reps.
Interesting. I mean, is that something you're scaling, or do you have too many leads for your 4 enterprise reps already?
We're looking to scale that, and what comes with it is obviously the leads and the good sales reps, and both are hard to find, especially the right sales reps that are very good at selling into enterprise, and not just into enterprise, but that have this mentality like we come in with something new. We're not like something that is faster or cheaper or better than what they're using right now. We're bringing a new thought process into a lot of organizations. So someone who can have this consultative background is very important.
How much total have you raised to date, or have you stayed bootstrapped?
So we've raised about $2.5 million.
Okay. Why did you have to raise all that? Why couldn't you stay bootstrapped?
So we actually raised it in the very beginning just to get our product and sales process going, and that took us to the break-even point.
So how much did you spend fully weighted on your MVP, like before your first dollar of revenue?
So before our first dollar of revenue, we spent probably like $500,000 or something.
Okay, so that's just you had to spend that getting the tech to the point where you could sell.
Getting to the point where we could sell, but again, like where we could sell, but sell to the enterprise.
What was that time frame? So when was the first line of code relative to the first dollar of revenue?
So first line of code was in around end of 2012. and but first dollar of revenue, I would say, like pilot revenue was in 14th. We were getting quite a lot of free pilots before, and then the true revenue we started generating in 2015, I would say.
And then fast forward today, how many customers are you serving?
So we're slightly above 50 enterprise deals.
Okay, 50 folks. That's great. 50 folks, scaling the team. Are you planning to raise anytime soon?
It's an open question.
Yeah.
Raising has its pluses and minuses, and for me, what's important is having the specific need, specific project for that raise, not just raising for the sake of raising, so that we get written about on TechCrunch and everywhere, but more about like what are the specific important milestones.
You've used both equity, which obviously you take significant dilution, and debt. You did a debt deal with Lighter Capital for $175,000 back in March 2016. Which one, in your opinion, which one has been more effective for you in terms of growing the company, but keeping as much upside for yourself and your employees as you can?
I'm a big fan of Lighter Capital model, to be honest, for two reasons. First of all, like as your company grows, your cost of Lighter Capital becomes much smaller. And
no. It's actually opposite. You correct me if I'm wrong, but let me just paint a picture for you. Most Lighter Capital deals, the revenue, what they'll lend you is something between 3 and 6x your current MRR, and you're paying back anywhere between 3 and 8% of your gross receipts monthly. And the payback that they optimize for is something between 1.3 and 1.6x over 2 to 3 years. If you grow fast and you're paying on a percentage of revenue, you pay it back faster, and the effective cost actually drastically increases.
Yeah, but the way I'm comparing it is to the equity that I'm giving up if I bring investors.
I see. But this is one thing that I wish venture debt would change. It shouldn't be more expensive the faster you grow it. People should figure out a way to make it less expensive the faster you grow.
Yeah, but let's say I agree with you, but at the same time, the faster you grow, the less painful it is to repay it. So the companies, I would say, the faster they grow, the less they're worried about.
But still, a dollar is a dollar, right? You'd rather put that dollar, instead of paying back interest, into the machine that you've created, which is getting more and more efficient.
That part is very true. That part of the model would be very useful to revise. And I think the second part with the venture debt, at least like in the Lighter Capital itself, is and I know they've been working on this, is increasing the limits that you can borrow.
Yeah. What they're right now, they cap out, I think, at like 1x ARR or something like that.
Yeah, but they're also cap it like at about $1 million.
In any company. Are you at full, like you're at $1 million already? You can't go any more from Lighter?
No, we're not, but getting a little bit more does not make sense for us. So, like, if they were to give me a significant amount, a more significant amount, I would be comparing them to potentially, like, when I go and raise. But raising another 300-400K from them would just not make a difference for me.
Why not? If it takes, once you raise with them, I've heard stories where CEOs will get money in like 48 hours. So the trick is, you don't have to,
sure.
So why don't you take another $300,000, reinvest it, then go take another $700,000, then reinvest it. Then, like, you see what I'm saying?
It's a possibility, but it's at some point like because reinvesting, like taking like $300,000 to $400,000. Yes, that could allow me like get more salespeople, but like getting really like kind of like big on marketing and advertising, that will probably not do the trick. So how
much would you target then? If you want to go out and raise right now, what would you target?
So we would be looking at something more closer to 10 million.
Okay, and what valuation would you like aim for? Obviously, you have to negotiate it, but what would you hope for?
It's like I'm not like at this point, like it's pretty standard to do like about 20-25% of the company.
Yeah, so you'd aim for like a 40 million pre-money.
Yeah, something like that. It's basically at that point, what the key would be is not even the valuation. The valuation is standard. If someone is trying to push you too much on the valuation, it's probably not a good investor for you in the first place because they probably don't understand the game. And the key for me is actually getting like when we go ahead and raise more, is getting the right investors, people I can work with. I've gone like we didn't start yesterday, so like we've been at it for a while. I've seen all sorts of different types of investors, had different conversations, and I've realized, and I've built a business.
Yep. Well, I mean, look, I think, by the way, George, I want to give you credit here too, right? I mean, you told me there are 50 customers, and if each one is paying a couple $100,000 in terms of average ACV, I mean, that puts you at like 1.2 million a month right now on revenue. Is that accurate?
I cannot tell you the exact revenue numbers, but we're looking at very good growth and at revenue. We're comfortable with not running and raising money right now.
Well, those I'm not making up numbers. I'm taking numbers you already gave me.
No, that's
so I want to correct one of those if they're wrong. Is the ACV actually lower than 300 grand? The average ARPU?
We have different cohorts in there. So
well, I know that's why people measure ARPU stand.
It's not necessarily the average. I cannot give you the exact average.
Okay, but I want to be clear. When I asked that question, I asked ARPU. ARPU stands for average revenue per customer, right? So if that's not accurate, I want to correct it. It's not 300 grand. It's less.
Yeah. No, I want to make sure. Yeah, I want to make sure that's our sweet spot. It's not necessarily because we have all sorts of different cohorts, plus quite a few of the legacy customers. So I want to make sure we're not misinterpreting the numbers.
Got it. Let me repeat this back to you because I want to make sure we get it accurate. You said earlier that minimum ACV is 50 grand.
Yeah.
Sweet spot 300. And you have some that are obviously anomalies that are big enterprise deals that are bigger than that.
Yeah, I don't think it's an anomaly. I actually think that's where we're getting as we're maturing.
You can measure it. You can measure it. Did 20%? Do your top 20% of your customers make it more than 80% of your revenue?
At this point, their top 20 customers, they're
20%.
Oh, top 20, yes, top 20.
Yeah, so it'd be like, do your top 5, 10 customers make up more than 80% of your revenue?
No.
Oh, okay. Then maybe they're more distributed than we talked about.
Okay.
Look, I guess what I will do is say, okay, 50 at your minimum, $50,000 ACV puts you north of 150 grand a month at this point. It's fair to say you're above that, correct?
Mm-hmm, of course.
Okay. Yeah. And you said healthy growth. So if you're there north of that today, where were you a year ago? Do you remember?
So a year ago we were slightly below half where we are right now.
Mm-hmm. Okay, so you're doing like 75 grand or 80 grand about a year ago?
We were doing about a year. Well, I don't want to get into exact because 150 is not the accurate number by itself. But we grew about slightly above 2x over the course of the year.
Okay, got it. So wherever you're at today, you were essentially 50% of that a year ago.
For our internal reasons, I just cannot disclose the exact number.
No, it's fine. We have a good range already, which is you're north of 150 grand a month in revenue. It sounds like, I guess what I'll ask is, does it feel like a massive stretch goal to get up to like $1 million a month by the end of this year? Or do you think you have to wait one more year to get that?
I think it will be sometime next year.
Yeah.
It's not going to be by the end of this year. You mean $1 million in
a month?
A month. Yeah. It won't be this year, but it will be sometime next year.
Yeah. Good. Well, look, and do you think most of that growth will come from adding new customers or getting more revenue from current customers?
I think our model right now is getting more into the doors of more companies. We do have land and expand strategy, but I can't say we've been amazing at it yet. We're pretty good. We're very good on customers, on serving the customers. We're very good on managing churn.
Yeah. Well, hold on. You can quantify that, right? So I have benchmarks on this, so I don't know if it's actually good or not. In terms of your churn, whatever you want to give, annual revenue churn, growth basis, what is it?
Mm-hmm. So in terms of the churn, again, if we look at the cohorts, if you look at the higher end of this, it's practically no churn. Very like we don't like the high end.
It better be net revenue. It better be above 100% net revenue retention.
Exactly.
Yeah, sorry, George. Just because we don't have time to go down all of your cohorts, I don't mean to keep cutting you off, but the reason people measure revenue churn is specifically so that every customer becomes equal relative to the amount they're paying per month. So if you look at your revenue churn across your entire base over the past 12 months, about what was it?
So it's definitely less than 2%. So it's
per month.
Per month, yeah.
Okay, so 24% annually, and then does your expansion revenue more than make up the 24% whole?
Pretty much, yeah.
Okay, so you're about 100% net revenue retention.
Yeah.
Interesting. Okay, good. And then look, managing cash is critical, and I always like to get in a founder's head to understand like how aggressive you're being. Are you comfortable burning a bunch of cash right now to drive growth, or you're trying to get to break even?
We're actually more on the break-even type of culture. So we are at that point where we got to break even. We're burning a little bit, but we're always.
What's a little? You're talking like $5 or $10 a month?
Probably like closer to 30 to 50 grand a month, but that's a comfortable zone for us.
That's good. Well, yeah, I mean, obviously with the revenues, you can buffer that however you want. And then how aggressive are you being to get new customers? So to get a new $50,000 ACV account, will you spend the full 50 grand up front or no?
Not the full, to get a 50K, we will not spend the entire 50K. We could, for getting like larger accounts, we do spend something closer, but it's not 50K, but it's pretty comparable to this.
My point is, are you optimizing for a 12-month payback period, and where are you at today in terms of your payback period?
We're actually, payback period is pretty good for us. Like we're at around, like I would say we're at around 6 months payback.
6 months. Okay, so on a $50,000 account, you'll spend 25 grand.
Yeah.
And most that's on salespeople person commission or paid spend or what?
It's mainly on the commissions and sales team, and we do very little, almost non-paid advertising.
Yeah, very good. All right, let's wrap up here with the famous 5. Number 1, what's your favorite business book?
So I really like the book I read recently. It's called Thinking in Bets by Annie Duke. It's about decision making.
Yep. Number 2, is there a CEO you're following or studying?
I like Mark Benioff for his bold decisions, even though I don't always agree with them, but he tends to be more right than I am.
If he offered, if Salesforce offered to buy the company for $10 million, do you sell today?
No, but I would be delighted that they're interested in us. But
Number 3, what's your favorite online tool for growing your business?
I like Todoist right now.
What, Todoist?
Todoist, yeah.
Number 4, how many hours of sleep do you get every night?
Try to get 7.
Okay, and how old are you?
I'm 38.
38. In situation, married, single, kids?
I'm married with a baby who is 14 months.
Oh, wow. Congrats. All right.
Yeah,
last question. What do you wish your 20-year-old self knew?
I think take more calculated risks. Don't follow the crowd.
Guys, take more risks. Rallyware.com. Again, playing in the space. It's a hot space. We all have heard about it. Again, performance management, especially across distributed workforces, 2.5 million raised to date. Burning call at 30, 40, 50 grand a month, driving growth. 40 engineers, 4 sales folks, 60 people total, 24% gross revenue churn annually. Expansion matches that, those so-called 100% net revenue retention. Doing north of basically 50 customers paying north of $50,000 ACVs, so-called, again, north of 250 grand a month right now in revenue, doubling year over year. So nice growth rate, hoping to maybe go out and raise they don't have to, they're at break even, but they might go out and raise, call it 10 million on a 30 or 40 pre, and the next call it 2-3 quarters. In the meantime, George, thanks for taking us to the top.
Thank you very much.